Hello investors and future investors, welcome to the channel. For today's video, I'm going to show you how to do option spreads in order for it to get consistent income. Yes, it does not matter whether you're bullish on the market or whether you're bearish on the market. These income generating option strategies can still help you no matter what direction the market takes, make money. Now, if you're new to options trading or you just get into options trading in order for you to make some additional income to support your 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you how to use option spreads in order to grow your small account portfolio. These option strategies work particularly well if you're trading with a small account. Now, you guys know how we do it. We like to get down and dirty with options, meaning we're going to give you the exact walkthrough, not only for you to be able to follow along, but maybe if you want to, you could practice this on your portfolio. But before we get into that, there's always two requirements I have for my subscribers and also my viewers. Requirement number one, always make sure to do your own due diligence before investing. What might work for my portfolio may not work for yours. Second requirement is going to be always make sure to have an exit strategy before entering any options trade. That way, if the trade does go against you, then you know how to get out of the trade. Now, for today's video, we're going to be featuring one of the hottest stocks in the market, which is going to be Tesla, and that ticker is TSLA. Now, before we jump into the action option strategies, I'm going to give you some basic due diligence that can be done in order for you to choose the direction of which option strategies you want to use. So for that, we're going to go ahead and go into the advanced feature right here, and that's going to open up the chart. Now we're here on the chart, we're going to go to the 1 year outlook right here in order to see how the stock perform. Of key importance for my personal views is going to be this blue line right here. This blue line right here is going to be your MA 200 or your 200-day moving average. And what this line does is that it gives you the price the stock has been trading at for the last 6 months, or rather 200 days. Now, as you can see here, for the last 6 months, Tesla has been trading around the 305 mark right there. But currently, the share price is this green one right here, and that is 332.23. So 200-day moving average around the 305 mark. The current share price 332. Now we're gonna go down and check and get some secondary confirmation, which is gonna be your RSI right here. We're gonna look at this line right here, and the RSI sits around an RSI of 51. So this tells you Tesla is not in overbought territory or is in oversold territory. For those of you not familiar with the RSI is a momentum indicator. And what it does, it tells you if a stock is overbought or oversold. With an RSI going towards the 70 mark, tells you the stock is going to overbought territory, and vice versa. An RSI going towards the 30 mark is telling you that that stock is going into oversold territory. Now, if we're going to go just one level up and look for a next level of support after the 332, it should be around here, which is going to be the 340 mark. Remember that? That's going to come in handy. So the next level of resistance, is going to be the 340 mark around there. Now, let's go ahead and let's get into these option spreads. Now, to do that, we're going to have to go to trade Tesla options down to the bottom in order to open up the options chain. Now, for those of you not familiar with the option chain, that is going to be this area right here. Now, this area right here gives us a lot of information, enough information actually, in order for us to make an informed decision to choose what option contracts we want to get into. Now, firstly, let's do your first option spread. Now, this is going to be a bullish option spread. So you're thinking the market is going to keep going up. So this is what you do. We're going to go to sell. We're going to go to put. And now we're going to go ahead and go to July 25th. Make sure to stay to the end of the video. I will be giving you a bonus of how you could make extra money on these option spreads. So now we're going to go ahead. We're going to choose our strike price. Our strike price is going to be, and you probably guessed it by now, it's going to be the 300 mark, or you can actually use the 305 as well. I just demonstrated that the 200-day moving average is around the 305. Now, the chance of profitability here is around 70%. Now, that does not matter. The reason why it does not matter is that we making this trade off of what we just saw, the 200-day moving average. So the chance of profit does not matter. The reason I mention it is that when we do the other spreads, you're going to see the difference. So chance of profit, 70%. So we're going to go ahead, we're going to select that. Now, this first leg is going to be a short put or a cash secured put. Now, because it's a sell option strategy, if you were to do this right now, you'd be receiving $13.10. Now, you could only do a cash secured put if you have the amount of money to act as collateral. The amount of collateral is going to be whatever the share strike price you choose multiplied by 100 shares. So in this case, it's going to be $30,500. That's why these option strategies are going to work particularly well if you're trading with a small account. So let's go to step two. Step two, we're going to go to buy right here. We're going to maintain put and we're going to maintain the strike date. And we're going to choose the one right below, which is the 300. We're going to go ahead and we're going to select that. Now, in this case, this one is now a buy option. So now we have to pay for it. The amount we're going to have to pay is going to be $11.55. This new option strategy is going to be known as the put credit spread. Yes, the put credit spread is a bullish option strategy. Once you do this, you're of the mindset that the share price is going to continue going up. It's going to trade sideways, and even if it does decide to go down, it's just not going to go to your 305 mark right here. Now, this is an income generating option strategy, so you're going to get paid. The amount you're going to get paid is the difference between your sell put right here, your 1310, and your buy put right here, which is 1155. The difference is going to be 1.55 or thereabouts. Let's go ahead. We're going to hit continue. Let's hit review order, and voila. So the put credit spread is an income generating option strategy. Once you do this option strategy, the amount of money you're going to be receiving is going to be $172.92, or let's round it up to $173. In order for you to do this option strategy, you will have to leave a collateral. The collateral you're going to be leaving is going to be $500. Now, let me tell you why I like this option strategy. I am overall bullish on the stock market. Now, the reason why I like this option strategy is because the ease of entry into this option strategy. If I were to do it, the amount of collateral I would need is only $500. The amount I stand to gain is going to be $172.92. Now, here's a trick that I use over and over again. So $173 is going to give you a 35% return. A 35% return is extremely, extremely high. So, but I do enter the trade, and this is why. What all you're waiting for before expiration date of July 11th, which is 25 days away, all you're waiting for is for it to be up on the trade around 25%. If you up on the trade around 25%, which is going to give you 25% of 173, that's going to give you around $43. The reason why you want to close off between 40% and 50% is because Tesla is an extremely, extremely volatile stock. This stock could flip in any direction possible at any given time. So when doing this trade, you do go out and give yourself enough time, which is 25 days. However, you're not looking to let this trade go to expiration. You're going to wait until you get a decent return, whatever you choose. It could be $25 return, $50 return, and then you close off the trade, and then you get your collateral released back to you. If you so choose, you could go ahead and do this trade again. Now, for those of you trading with a small account, be very careful. Always pay attention to the PDT rule or the pattern day trade rule. This rule says that you cannot do 3 or more day trades within a 5-day period. So if you are doing this, here's a trick I used to use to get around this. I would open a trade on one day, and then I would get out of the trade probably the next day or the next 2 days if I reach my target profit. So remember that. Do not get caught with the PDT rule. If you do get caught, your account will be shut down, and it's going to be shut down for a period no less than 90 days. I've never had this happen to me, but I've heard it happen to people, and this is not very good. If you decide to switch accounts to Webull or another broker, you still will not be able to trade, so be very, very careful with that. So this is one option strategy, which is the put credit spread, which is a spread strategy that can be used if you're bullish on the stock in order for you to make income. Now, if you're bearish on the stock, here is an option strategy that can be used, and this also going to help you make income. So We're going to maintain our strike date of July 11th, which is the 25-day mark right here. And then now we're going to go to sell and we're going to go to call. We're going to flip the switch right now and we're going to go above the share price. This time, we're going to use chance of profitability as a basis for choosing our strike price. Remember, I told you the chance of profitability for the first credit spread, we did not really need the chance of profit. It's not very integral because we did it based off the 200-day moving average. This one here, we need a chance of profit because we don't have any clear definition of the upside. Now, I did show you the level of resistance was around 340. At this $80 chance of profitability here, which gives us the 365 strike. The 365 strike is way above the 340, which is the next level of resistance. So all that does, I'm not saying you're going to win this trade. What I'm saying is that this increases your chance of this trade going in your favor. So that is why I do some basic technical analysis in order for you guys to win this trade the majority of the time. So we're going to be going with a 365 strike price right here with an 80% chance of profitability. And once again, this is a sell option strategy. So we're going to be paid. The amount we're going to be paid is going to be $10.05, which is going to be $1,005. Let's go ahead. We're going to click into this one. Now, this first option strategy is going to be a covered call. In order for you to do a covered call, you must first own 100 shares of the stock. If you need to own 100 shares of the stock right now, you could have bought it at any price below the 365. You could have bought it a year ago. It does not matter what your price point is. The thing that's really important is that you must own 100 shares in order for you to do the covered call. What we're going to do now is that we're going to alter the covered call option strategy by going to buy and call, and then we're going to maintain our exact same strike date. This time we're going to choose a strike price, and the strike price we're going to be choosing is going to be right above our sell call. That's going to give us the 370 strike price. Now this one is a buy option strategy, so this one we're going to have to pay. Let's go ahead. We're going to click into it. This new option strategy, which is another income generating option strategy, is going to be none other than the call credit spread. The call credit spread is a bearish option strategy because by doing the call credit spread, you're of the mindset that the share price is not going to go up to your 365 price here. It's either going to go up a little bit, it's going to go down, or it's going to stay where it is. Now, with the call credit spread, let's go ahead. We're going to hit continue. We're going to hit review one more time, and voila. Now, income generating option strategy, you're going to be paid. The amount you're going to be paid is going to be 102.92, or we're going to run it off to $103. Now, if you were to divide your $103 by the amount of collateral you have to leave, once again, the collateral for this one is also $500, then you should be getting around a 20% gain. A 20% gain, investors and future investors, is extremely high. The reason why we're selecting these strike prices is that we want to start off high, or whenever the trade meets our target profit, we're going to close the trade. Once again, we're not going to wait for this trade to go into expiration. We're going to close this trade before that happens. If we up on the trade around anything $25 to $50, depends on your personal preference, your personal goal for your portfolio, then you're going to go ahead and you're going to close the trade. Once you close the trade, you're going to lock in your investment gains and you're going to have your collateral released back to you. And then you may choose to, if you want, to go ahead and do another credit spread, perhaps on Tesla or perhaps on a different stock. But that is how you keep recycling the same amount of money in your portfolio in order for you to continue generating income. Now, be very careful. Credit spreads are defined risk option strategies, meaning if this trade were to go to expiration and Tesla does not hit your mark, then you're going to lose almost your entire $500. In this case, the amount you're going to lose is going to be the $500 left as collateral minus the amount of money you received as your option premium. So you're going to stand to lose that. So that's it, investors and future investors. These are credit spreads that are used if you're trading with a small account in order for you guys to make consistent income. My best advice I could give if you guys are doing credit spreads, always make sure to close your trades before expiration. That is so important. I have seen and heard disastrous stories, so please close your credit spreads before expiration date. Now, for those of you that are trading with a big account and you guys want to make even more money, here's a trick that you can use. All you need to do is to go ahead and increase your amount of contracts. So now, if you want to make twice the amount of money, you're going to increase your contracts right here to 2. What's going to happen is that your estimated credit is going to double as well. So now you're going to stand to gain $206, but then your collateral is going to go up to $1,000. That's if you're trading with a big account, and $1,000 represents only a very small part of your account. So if you are trading with an account that allows you to use $1,000, then that's a way to increase your money. Once again, if you were to increase the amount of contracts you did, now your time to close the trade is going to be even better. Here's how it's going to be better. Instead of waiting for the trade to get to $20 when you had one contract, now you could wait until the trade gets to a little less than that, because now you're going to be making a lot of money. The key idea here is for you to make sure to get out of the trade and keep your collateral. Your collateral is what you're going to be using over and over again. Now, investors and future investors, if you guys have any questions about using credit spreads in order to generate income, let me know in the comments below. If you guys need help trading options for income, then I do offer one-on-one coaching. That link will be in the description below. Feel free to go ahead and click on that link. Now, that's it for today's video. Go ahead, like the video, subscribe to the channel. Make sure to hit that notification bell to get an alert when I post a video. But most importantly, if there's anyone out there you know struggling to grow a small account portfolio, then the right thing to do is to go ahead and share this video with them. We're trying to help as many as we can get out of that 9 to 5. Now, until the next video, keep pushing your investments.